For more than a century, managing money meant standing in rooms exactly like this one. American finance was built on physical branches, human tellers, paper deposit slips, and waiting in line just to access your own capital. Every transaction, every ledger update, and every basic accounting task required countless hours of manual labor. Armies of clerks worked through stacks of paperwork just to keep the financial system from grinding to a halt. Today, that friction is gone. Millions of Americans now execute those exact same tasks, moving thousands of dollars, securing loans, balancing accounts, entirely within the microprocessors of their smartphones. Behind the glass of those screens, algorithms are constantly active. By scanning thousands of data points a second, modern financial assistants detect unusual spending patterns and can alert users to cash flow problems weeks before a bank account hits zero. The massive physical infrastructure that once defined American banking is no longer the primary engine of finance. The mathematical lifting required to move capital now happens invisibly, in fractions of a second. Handing control of our personal finances over to artificial intelligence solves the problem of speed, but it forces us to ask if we are guaranteeing our wealth or creating vulnerabilities we have never faced before. Erasing the pain of old-school banking makes spending easier. Yet removing that friction creates a massive blind spot where the average consumer loses sight of how their money actually moves and who is really watching it. To understand how this technology ended up on your phone, we have to look at the proving ground where the algorithmic revolution actually started. For decades, moving capital on global markets depended entirely on human perception. Profit margins were dictated by how quickly a trader on a crowded floor could read a screen, analyze a pattern, and shout an order. That physical bottleneck was eliminated by algorithmic trading. Institutions replaced floor brokers with machines capable of ingesting massive global datasets, news feeds, weather patterns, and historical trends, all simultaneously. These systems execute complex trades in milliseconds. They spot global opportunities and secure profits in a timeframe far shorter than a human brain takes to register a single thought. Over time, the processing power required for institutional trading became cheaper and more accessible. Those exact same data crunching capabilities filtered down, repackaged as the retail banking applications millions use today. Instead of a user manually logging receipts or calculating monthly expenses, the software categorizes every purchase in real time. It maps out budgets and identifies saving opportunities without any human input. The tedious process of maintaining complicated personal spreadsheets at the kitchen table is obsolete. By putting Wall Street-level analysis into the pocket of the everyday citizen, high-speed data processing and instant market access are now available to anyone with an internet connection. But extreme efficiency comes with a severe cost. When machines execute complex analysis flawlessly, the people who used to do that work are forced out. Entire sectors of white-collar finance are being hollowed out. Entry-level data analysis, basic accounting, and routine portfolio management, roles that provided stable career paths, are evaporating. Professional survival now requires a pivot. The new opportunities lie in overseeing the data, managing the algorithms, and securing the digital infrastructure. That security is critical because the complete digitization of wealth creates an incredibly lucrative, highly centralized target for cybercriminals. When wealth is code, a single vulnerability in a banking network can expose an entire financial identity. Securing that money now happens at the level of the firewall and the encryption key. Data privacy and digital defense are no longer isolated IT issues operating in the background. They are the active, daily frontline guardians standing between a citizen and total financial ruin. The same automated systems that build modern wealth also introduce a single point of failure. Protecting that money requires just as much vigilance as earning it in the first place. Those massive, marble-columned institutions that once physically guarded American wealth are effectively relics. Modern banks function as complex, constantly updating software codebases. They manage digital ledgers that represent trillions of dollars in movement without ever touching a physical bill. Because the software is so intuitive, it is easy to assume the technology can replace personal financial education. Delegating math to a machine is safe. Delegating your financial judgment is highly dangerous. This reality creates what economists call the human premium, the vital ability to oversee, audit, and actively direct the algorithms managing your assets. Algorithms only know how to optimize for numerical growth based on historical patterns. They cannot weigh ethical boundaries, and they do not know what actual life goals you are trying to achieve with that capital. In this modern economy, merely possessing capital does not guarantee financial security. The ultimate wealth in an automated world is the literacy required to command the machines. If you do not understand the mechanics of the system, the AI will dictate your financial reality rather than the other way around.